Before we get started, I want to remind everyone that the information in this presentation is not to be or construed as investment advice. The information presented are subject to change without notice, and while we have made every reasonable effort to ensure that the content is reliable and accurate, we have not independently verified the content and are not responsible for errors therein. Please consult a professional advisor before putting a Loonie in any of these financial markets. Hi everyone, my name is Richard Diaz and welcome back to the IceCap Canadian Market Wrap. In this week's episode, I'm going to do a quick overview of the Canadian equity market. As a reminder, this is not investment advice. Please seek professional help before putting a Loonie in any of these markets. The following will be a high-level look at the Canadian equity market. It's a subject that I think there is not enough coverage on, and as we go forward, we'll touch on it more and more, especially when and if there's volatility in the space. So last week, I left you with the following chart, highlighting the strong performance of the Canadian equity market, especially in relation to the Canadian bond market. We'll touch on the Canadian bond market more as we go into the fall, especially when the big, beautiful budget deficit comes out. But some of you might be asking, what is the Canadian equity market? For the uninitiated, Canada's largest and most significant stock exchange is the Toronto Stock Exchange. It handles most of Canada's trading volume. It's home to well-established, large-cap companies that operate across various sectors, including finance, energy, and mining. The TSX is a fully electronic stock exchange with all transactions conducted in Canadian dollars. It ranks as the 10th largest stock exchange globally, although that does fluctuate from week to week, and it is the third largest in North America, following the New York Stock Exchange and the NASDAQ. The TSX is known for its strict requirements, and it only allows companies that meet specific size, regulatory, and disclosure standards to list and trade there. By contrast, the TSX Venture Exchange generally lists more speculative companies in higher potential sectors like mining and oil and gas, and some biotechnology firms. The CBOE Canada stands out for its offerings, which are dominated by derivatives and options, ETFs, and Canadian depository receipts. And meanwhile, the Canadian Securities Exchange champions emerging industry, notably cryptocurrency, some tech companies, and some very small mining companies. Together, these exchanges create Canada's capital market ecosystem. One way to think about Canada's equity market, or any market for that matter, is its sector composition. And we look at this by calculating the sector market cap as a share of the total. We can then simply subtract the global sector weight from Canada's sector weight and can see how each sector stacks up. If the weight is higher, we call it an overweight. If it's less than the global average, we call it underweight. As some of you may know, Canada's equity market is dominated by financials, specifically banks, and as you can see on the right-hand side, the same is true for the energy sector, or oil and gas, and basic materials. Canada is significantly underweight technology. Something else to look at is valuations, but admittedly, this is more important at the extremes, both high and low. This one before you is of the 12-month trailing earnings versus the price of the equity market, or PE ratio. And as we can see, Canada is in the middle of the range. More expensive than Europe, but much cheaper than the US. This is a function of the sector composition. Some of the US tech companies trade at extremely high multiples, and Europe, which has very little tech and often bogged down by cheap banks, has a lower multiple. Although, as you can see, this does change over time and throughout the cycle. Going forward, maybe we'll do a video on valuation measures and financial metrics investors look at, but here's a table that covers a fair number of them for the Canadian equity market. For example, the forward price earnings ratio, which is the price investors pay for the expected earnings of a given stock or sector. Asset turnover, a financial ratio that measures how efficiently a company or sector uses its assets to generate revenue. And the dividend yield, a ratio that shows how much a company or sector pays out in dividends relative to its stock price. Financial ratios are useful because they transform raw financial statement data into standardized, insightful metrics that can reveal a company or a sector's financial health, performance, or efficiency over time and against its peers. So with the proviso that past performance is not indicative of future results, let's take a look at what sectors are doing well this year. And we can see from the table that basic materials and consumer staples have done really well this year, whereas energy, industrials, and consumer discretionary stocks have badly lagged. I'm ignoring healthcare because, as we saw from the chart above, it's just a tiny fraction of Canada's equity market. We can see the performance of the top sectors in a different way on this chart. Over the last year, energy has lost out to basic materials, and financials have beat industrials. And simply looking at these four sectors can tell you a lot about the equity market. Something that is important to note here is that the market is not always a good reflection of an economy. We can easily see this when looking at a country's gross value added, a GDP proxy. For instance, in Canada, the economy's largest sector is real estate, which is a conversation for a different day. But those companies are often very small and unlikely to be listed. Similarly, healthcare is a big chunk of gross value added, but is dominated by the public sector in Canada, and so there is very little representation of it on the TSX. The point here is that you have to be careful when translating economic activity to equity market performance or earnings. An extreme example of this is when a small country has a very successful company that sells its products or services globally. Think Danish weight loss drugs that sell to US markets and other markets and have an extremely large chunk of their valuation as a percentage of their local equity market. The last thing to consider today is expectations. And often it is the performance of, let's say, earnings relative to those expectations that will move the market. In past videos, I've shared with you how expectations are key with economic data like inflation or employment. And the same is true for equity markets. In this chart, I've shown earnings expectations, and the panel on the left shows how they have gone from extremely negative to positive. And this change can often help explain market sentiment and relative performance. All right, so that's a wrap on this week's episode. Thanks again for watching. Please like, subscribe, and follow for more. And as always, we manage money for families all across Canada and the world, so please feel free to get in touch.